U.S. stock markets are officially open for trade, and stocks are fractionally lower as we begin the session. Joining me now is Dean Smith. He's the chief strategist at Folio Beyond and portfolio manager at Riser ETF. Dean, welcome to the show.
Good morning.
What are you tracking most closely as trading for the week kicks off?
Yeah, well, we obviously had the big news coming out of the Fed last week that they're now on a path to cutting rates. For us, this is kind of troubling because this Fed seems to have some sort of color blindness when it comes to incipient or emerging inflation. We see the risks between inflation versus labor, much more concerning on the inflation side. We've obviously had some soft numbers in the non-farm payroll, but the jobless claims numbers have continued to be pretty firm. The unemployment rate is still around 4.3%, which is full employment. We think the Fed's taking their eye off the ball here.
All right, and what challenges do you think the Fed faces as it tries to stick to its dual mandate?
Well, they've got a real big challenge coming from the administration. Obviously, the presidential administration would like to see interest rates a whole lot lower. The Fed obviously has control over the Fed funds rate, which is a very short-term interest rate. They can make that be whatever they would like it to be. They don't have much control over the long end of the market, 10 years, 30-year bonds. Those rates have actually increased since the Fed announced its rate-cutting policy last week. So we think that the curve is going to continue to steepen from here. We think that the market is going to understand that inflation is more of a problem than the labor market, and that it makes sense for people to start thinking in those terms.
And we've heard a lot about the recent weaker than expected employment figures. What sectors are most affected, and how should investors be approaching this?
Well, I tell you, the number that got everybody's attention and scared some folks was the big revision to the non-farm payroll a couple of weeks ago, down 900,000, and revising the monthly numbers to around 25,000 increase per month. But a large part of that is really tied up in some complicated movements of self-deportation, sometimes it's referred to, of undocumented workers out of the U.S. since the beginning of the year. Somewhere between 1 million and 1.5 million undocumented workers have left the U.S. and gone back to Mexico or other countries, and that puts a big hole in industries like construction, for example, which employs a large number of undocumented workers, obviously the agricultural sector. So we think that pulling this much the labor force in some really key important sectors is going to continue to put upward pressure on wages in those sectors.
All right, and how should traders be approaching tariffs, and when do you think the impacts will start to be felt?
Well, here's the thing. Tariffs are not going away. The administration has had a couple of losses in court cases, and now it's headed to the Supreme Court. But Howard Lutnick, the Commerce Secretary, announced a couple of weeks ago, they don't care. They feel like they've got lots of authority under other statutes and other regulations to keep these tariffs in place, so they're not going away. That means that companies that have been absorbing the tariff, as we've seen announcements from some of the car companies and other companies, on the hope that maybe these tariffs were a temporary thing, that they wouldn't have to absorb them, they're going to start to pass those along. And we're going to see the impact of those tariffs come through onto intermediate goods and final goods prices for the rest of this year, and even more so into 2026. This is just getting started.
All right, and let's shift to AI. Artificial intelligence, what do you think the timeline will be for widespread implementation?
Yeah, listen, AI is obviously a very big deal. People have compared it to the internet, the railroads, whatever you might want to look to historically. The reality, though, is that it's turning out to be a whole lot harder to integrate these AI technologies into your business processes in a deep and meaningful way. Let's be realistic. It's going to take 5, at least, maybe more like 10 years for AI to be fully adopted and integrated into business processes. And in the meantime, maybe NVIDIA stock continues to go up. I don't really know. But AI is not going to ride to the rescue here in the near term to save us from the inflationary pressures that we see out there.
And Dean, given the latest uncertainties, how are you advising your clients right now?
Well, a couple of things. We've obviously got a couple of ETF products, RISR and FIXP, that we think can play a really important role in investors, helping them to manage interest rate risk and credit risk and all the things that they really care about. People should be really well diversified, not taking big risks here. We've actually published a white paper on sort of how the bond market investment management paradigm has changed. You can find that on our website at Folio Beyond. But people need to be careful here. Now is not a time to throw caution to the wind.
All right. Thank you, Dean Smith, Chief Strategist at Folio Beyond and Portfolio Manager, Riser ETF. Still to come, Ranger Energy